Hello, this video is about how long will it take to double your money. This formula shows you. The rule of 72 is one of investing best mathematical shortcuts. By dividing 72 by an investment expected annual return rate, investors can quickly estimate how many years it will take to double their money through compound returns. Financial advisors and individual investors have used this mental math tool for decades to assess investment prospects and set realistic portfolio goals. While sophisticated financial calculators are found all over now, the rule of 72 can help you on the fly to quickly compare different investment options and time frames. Below we explain how to use it and what to look for when considering different rates of return. How the rule works. Understanding the rule of 72 requires no advanced math skill or financial expertise. The formula states, for example, if you expect a 6% of your annual return, doubling your money would take about 12 years. 72 divided by 6 equals 12. The beauty of the rule of 72 lies in its simplicity. It transforms complex financial concepts into decisions anyone can understand. The rule becomes particularly useful when comparing different investment options. Consider these common scenarios. A savings account paying 1% interest, 72 years to double, 72 divided by 1 equals 72. A corporate bond yielding 4%, 18 years to double, 72 divided by 4 equals 18. A stock portfolio averaging 8%, 9 years to double, 72 divided by 8 equals 9. For returns under 10%, the rule of 72 provides remarkably accurate estimates for expected annual returns. However, its precision decreases with very high or very low rates. The companion formula, the rule of 69, offers more accurate results for such cases, but is less practical for quick mental math for most. Here are the rates and how long it would take for your initial investment to double. Investment long-term rate of return, time to double years. S&P 500, 10.2, 7.1. Corporate bonds, 7.3, 9.9. US Treasury bills, 4.4%, 16.4. Gold, 7.7%, 9.4%. Real estate investment trust, 8.8%, 8.2%. Rates of return as of year end 2024 for the previous 2000 year period. Real world applications. Suppose you are planning a cross-country road trip, just as you would want to know how long it will take to reach your destination. The rule of 72 helps you map your financial journey. Let's look at common scenarios to see how this works in real life. Say you are a conservative investor and just received a $10,000 bonus. If you put it into high yield savings account earning 4% interest, the rule of 72 tells us it would take about 18 years to return into $20,000. 72 divided by 4 equals 18. That might work for a long-term emergency fund, but what about growing your wealth? You are comfortable with stock market volatility for the chance of higher gains. You invest instead in a low-cost stock market index fund aiming for the market's historical average return of about 10%. You could double your money in just over 7 years. 72 divided by 10 equals 7.2. Remember that unlike savings account, stock market returns aren't guaranteed and high and can vary significantly from year to year. A big mistake novice investors make is trying to compensate for lost time when they aren't investing by chasing unrealistic returns rather than adjusting how much they are putting toward their investment account. Here is where it gets interesting. Thanks to compounding, your money can double several times over extended period. At the same 10% return rate, your initial $10,000 could grow as follows: $20,000 after 7 years, $40,000 after 14 years, $80,000 after 21 years, $160,000 after 28 years. However, that's only the story's beginning, since you will need to account for how fees, taxes, and other factors claw back some of your gains. Here is a chart assuming a robust 10% annual gain with these factors included. Limitations and considerations. While the rule of 72 provides valid estimates, several factors can extend the time needed to double your money. Often averaging 2% to 3% annually, inflation erodes purchasing power. A 7% investment return during 3% inflation only provides 4% actual returns, extending your doubling time from about 10 years to 18 years. The biggest surprise for many investors is in how fees impact them today. It is how those small percentages compound into real dollars over decades. Investment fees create another drag on returns. A mutual fund charging 1% annual fees effectively reduces a 7% return to 6%, lengthening the doubling period from 10.3 years to 12 years. When combined with inflation, these factors can significantly impact long-term results. Taxes also play a crucial role, particularly in taxable accounts. An investor in the 24% tax bracket earning 8% returns might only keep 6% after taxes, extending their doubling time from 9 years to 12 years. Tax advantage accounts like 401k and individual retirement accounts, IRAs, can mitigate this impact. Historical context matters. Examining how investments have performed historically can help us set realistic expectations. Let us discuss how different types of investments have grown and sometimes shrunk over time. Take the US stock market, measured by the S&P 500. Someone who invested $10,000 in 1970 and reinvested all dividends would have doubled their money multiple times, even with the same scary drops along the way, like 1987's Black Monday or 2008's financial crisis. Patient investors generally had accounts with money doubling about every 7 to 10 years on average. However, not all investments grow at the same speed. Here are different investments have typically performed. Bank savings, 1970 to 2023, usually doubled every 10 to 14 years. Government bonds typically doubled every 10 to 12 years. Gold has been all over the map, sometimes doubling in just a few years, other times taking decades. Real estate generally doubled every 10 to 15 years, through this varies a lot by location. Stocks have climbed about 10% yearly for the last 50 years, doubling just about every 7. The key lesson: is that faster growth usually comes with increased ups and downs. Think of it like choosing between different roads, the same destination. The highway might get you there faster, but you will hit more bumps and face more risks than the slower route. How you can use the rule of 72 to evaluate whether I am on the track for retirement. Let's answer with an example. If you are 35 with $100,000 saved and hope to retire at 65 with 800,000, you will need to double your money 3 times in 30 years. Does the rule of 72 for calculating losses too? Yes, if investment loses 6% per year, cutting your money in half would take about 12 years. 72 divided by 6 is equal to 12. How does the rule of 69 work? The rule of 69 dividing 69 by your expected return rate gives you more accurate answer when dealing with continuously compounding investments, meaning those that grow many times throughout the year rather than just once. For example, if you are earning 6% on your investment, the rule of 72 says your money will double in 12 years, while the rule of 69 says it will take 11.5 years. Continuous compounding makes the rule of 69 more accurate in real life. If you are dealing with regular investment accounts, stock market returns, or just doing quick planning calculations, stick with Rule 72. Save the Rule of 69 for when you are working with investments that compound daily or continuously, like some high yield savings accounts or certain types of bonds. Or when you need more precise calculations for professional financial planning. The bottom line, while the rule of 72 provides a handy shortcut for understanding investment growth, it is most valuable as a reality check and planning tool. Whether evaluating investment options or planning for retirement, remembering that even good returns take time to double your money can help protect you from unrealistic promises and keep your expectations grounded. It lets you understand how fast your money can grow realistically, while accounting for speed bumps like fees, inflation, and taxes. I hope you like this video. Thank you very much for watching it. It will be useful if you want to invest money in the investment area. Thank you. Please subscribe to my channel. I will do more for you. Thank you. Bye for now.